Chapter 4: The Business Life Cycle. The graph below illustrates the life cycle for a typical business over time. One can analyze a business with regards to its stage in its life cycle in order to gauge its funding and working capital needs. Launch. During this phase, a business is providing its product or service in the market for the first time. It is building its brand and has the objective of growing its customer base quickly in order to increase its sales. The business would be earning revenue for the first time, and this would rise steadily from a zero base depending on the rate of growth of sales. Working capital. As the business starts to make sales, it may not have much negotiating power with its suppliers. It may see a relatively small net outflow of working capital at this phase due to cash being tied up with its customers as it waits for payment, and due to its suppliers needing to be paid relatively shortly after providing raw materials to the business. Thus, the business would need working capital funding to bridge the short-term gap between the time it pays its suppliers and the time it receives payment from its customers. Debt. The business may require longer-term funding to purchase the assets needed to manufacture its products. Typical startup costs include marketing, advertising costs, office equipment, and other general expenditure. The debt requirement would generally be small at this stage, as management would most likely adopt a steady and prudent growth strategy in the beginning years, as they gather knowledge and proficiency in their industry. Growth stage. During this phase, a business would see rapid increases in sales volumes as its customer base increased. Revenue. Growth would be rapid. However, due to teething issues or aggressive pricing strategies, profit margins may be narrow at this stage of business development. Working capital. Demands on working capital would increase as the business's order book would grow. The business would still not be in a dominant enough position in its industry to negotiate preferable terms with its suppliers, but would need more and more cash to fund the increases in its raw material purchases over time. The business would not yet be in a position to offer its clients credit, as it would need all the capital possible to fund its growing order book. If the business was to run out of short-term capital, it could resort to discounting or factoring in order to meet large client orders. Working capital is the most critical factor influencing a business's ability to continue to grow at this phase. Businesses may also approach banks to provide them with working capital debt facilities. Debt. At this phase, a business would invest in assets to facilitate its expansion. For example, larger business premises and more machinery. The business would approach both debt and equity funders to facilitate this expansion. It would be the job of the Treasury Department to negotiate the best debt or equity funding terms possible. Maturity. At maturity phase, a business has grown its market share to the point where the marginal cost of increasing its market share outweighs the marginal benefit of it doing so. Revenue. The business is no longer focused on aggressive growth at this stage and is more concerned with maintaining its market share in the industry it operates in. Revenue begins to plateau. However, the business may focus on improving efficiencies and bringing costs down in order to improve profit margins. Working capital. At this stage, a business is now a dominant player in its industry and can negotiate preferential terms with its suppliers. It can extend its payment terms or spread out payments to suppliers, thus reducing the need to fund its working capital from other sources. The business may also offer credit to its clients. Although this may increase its working capital requirements, it may be a powerful strategy to retain customers and earn higher profit margins. The business would perform adequate credit checks to ensure that its debtors book had a desired credit rating. Debt factoring would be an unlikely source of funding for the company, as it may be able to raise cheaper working capital facilities from banks in order to meet its short-term funding needs. Debt. A business would begin to amortize the debt it used for its expansion program. It would be the job of the Treasury Department to calculate a sustainable long-term debt level for the company, which would maximize its return to shareholders. Treasurers could utilize the capital asset pricing methodology to determine the optimal debt structure of the company. At a mature level, a company's long-term debt structure would consist of bonds, amortizing debt facilities, or revolving credit facilities. Decline. As an industry matures, new entrants may increase competition, driving market share down. It may also be the case that the industry is made redundant by new technologies or social disruptions. It may be possible for companies to adapt to change and reinvent themselves, thus restarting the cycle over and over again. They would need to invent and launch new products or perform their business functions differently in order to do so. Revenue. In a decline, revenue begins to shrink as market share and sales decline. Companies would need to keep an eye on costs in order to ensure profit margins are maintained. Working capital. A declining order book, a lower inventory requirement, and years of optimizing production procedures may see a further reduction in the need for external working capital, and perhaps even a release of previously tied up working capital. Companies may decrease their working capital facilities held with banks as their need for short-term funding decreases. Debt. As the business's operations decrease, their debt capacity may also decrease. Amortizing debt may not be refinanced, causing the net debt position to fall.